welcome to those of you online. Hopefully you can hear me. Welcome to the final TSP seminar of 2022. We've got our usual quick fire round plus two guest speakers. We've got Piyush Patel, who will tell you all about himself in great detail, I'm sure, but he's a senior manager in our tax dispute resolution team, and he's the primary contact for tax support. So some of you may well have already come across him in that capacity. We've also got our new VAT line partner, Chris Rowe, who's definitely going to tell you all about himself. But suffice to say that he's worked both in practice and in industry, and he heads up the VAT line team. That's all right. He's going to be covering topical VAT issues. That's our two specialist speakers, and Sadiq did such a great job in October. We've invited him back to do the quick fire round, so he's going to do that. Next slide, Natalie, please. Fantastic. So that's what we've got lined up. News topics, hot topics, tax dispute resolution, VAT, and questions and answers, which I'll do my best to avoid. Next slide, please, Natalie. And there are your speakers, Sadiq, Chris, and Piyush. Next slide. There you go, Sadiq. It's all yours, mate.
Okay, thanks, Malcolm. All right, so I'm just going to be covering off the direct tax news budget updates, autumn statement updates, sorry. So if you go on the next slide, I'm first going to cover the changes which were announced that affect individuals. So Jeremy Hunt, he said that everyone is going to pay more tax. The main reason for that is because he has frozen the allowances and the bans till April 2028. So that's the magic date. It's going to be frozen till April 2028. And then he did also announce two changes. The first one's that dividends allowance. He is going to half the 2,000 limit, which it is currently now, to 1,000 from the next tax year. And the tax year after, he's going to half that 1,000 again to £500. Right, so the second change, which was announced, I'm sure you've all heard of this already, is the additional rate tax band. Currently, a 45% income tax rate applies for taxable income above 150,000. That's being reduced to 125,000, 140. So that'll get more individuals in that 45% tax rate. That was it, just two changes, and the freezing of the bans and the allowances till April 2028. Next slide, please, Nas. Right, so in this table, it's been recently updated following the autumn statement to show what would the profit extraction rates be if you took out a salary or a dividends as a company owner. And in this table, you'll see that the corporation tax rate, it has been announced that it's going to be increased to 25% from 19%. That's going to be the main rate, so only for large companies. I'm going to speak more about that later, but large companies, for this purpose, is any company with taxable profits above 250,000. So companies with profits of 50,000 and below, they're still at the 19% rate. The ones in between, they're getting taxed another rate according to marginal rate relief calculation, which is quite complicated, but we'll cover it later. The main thing I want to talk about in this table is, for the first time in, I don't know, possibly forever, it's now cheaper for owner-managed businesses, owner-managed owners to take out a dividends over a salary if they're a higher rate taxpayer or an additional rate taxpayer. You'll see that the difference is it's about 0.6%, 0.8%. That's just, I think it's the government encouraging more owners to take out salary because they want that PAYE tax every month instead of waiting a whole year for someone to do their tax return, give the dividends tax over. So there's a bit of an incentive now for additional rate taxpayers, high rate taxpayers, take out a salary instead of the dividends. Of course, this assumes that it's going to be a large company, or actually that 25% rate also applies to any company which is a closed company, and it's an investment company. So it's going to catch a lot of family investment companies. Any investment company is going to be 25%. It's still cheaper for a basic rate taxpayer to take out dividends. Okay, next slide, please, Natalie. Okay, so capital gains tax. There was a lot of speculation that there's going to be an increase in CGT rates from next year. That didn't occur. Actually, no rate changes occurred, so they're all going to remain the same. The only thing that did change was the annual exemption. Currently is 12,300. That's going to be reduced next year to 6,000, and the year following, that's going to be half the end of 3,000. So it's just bringing more people in within CGT. Like Jeremy Hunt promised, more people are going to pay tax. IHT, nothing's changed. The bans are keeping the same till April 2028. And that's all you've got to remember. That's the magic date. And that's it for IHT. So next slide, please. Now, there was a small technical announcement made, and this just affects non-DOMs. Okay, it came into effect immediately, but the legislation hasn't been drafted, and there's been no guidance on it so far. So we're going to have to wait and see. But here's the change. So it's to do with the share-for-share exchange rules. So as we all know, probably that when an individual exchanges his shares for shares in another company, the automatic share-for-share exchange rules take place. These are within section 127 to section 135 PCGA 1992. These rules automatically occur as soon as a share-for-share exchange happens, as long as it's a commercial transaction. Sometimes we do clearances under section 138 to give HMRC assurance that actually it's been a commercial transaction. As soon as it's a commercial transaction, it falls within share-for-share exchange rules. So let me just tell you why these rules came in. Non-DOMs, they used to do the remittance-based selection, right? So they used to have shares in a closed company, which was in the UK. Then they exchanged those shares for shares in a company which is overseas, right? And then later on, so at the moment there's been no CGT disposal because of the automatic share-for-share exchange rules. And then later on, that non-DOM would dispose of those non-UK shares. And then because he's on the remittance basis, those shares would be offshore gains and then not within UK tax. So HMRC would have lost out on that gain that was rolled over from that share-for-share exchange. Right, so the government's now going to stop it, and this is going to apply immediately, and it's just basically going to treat the disposal on the non-UK shares as a UK share disposal. So it's going to be taxed on the arising basis, even if it's a non-DOM claiming the remittance basis. Right? Just a couple of things on this. So this will only apply to closed companies, and it'll only apply if the shareholder has at least 5% material interest in the company. Okay, and another thing about this is it also applies to dividends income received from that non-UK company. So dividends income and any gains, they're going to be taxed on the arising basis on non-DOMs that have entered into share-for-share exchanges with overseas companies. That's it, simple. All right, next slide, please, Natalie. Okay, so corporation tax. So Jeremy Hunt confirmed that from next year, the main rate of corporation tax will be 25%. As I mentioned, that will only be for large companies, so those with profits above 250,000. Smaller companies, it's going to remain at 50,000. They've also increased diverted profits tax, and the bank surcharges actually reduced. So there are other changes that are announced, probably more niche. And like I talked about before, there's a marginal rate for companies which have profits in between 250,000 and 50,000. Funnily enough, I did this in my CTA exams, and it's a complicated formula to figure it out. It depends on how many associated companies you have in the group. You can find the formula on HMRC guidance. But funnily enough, once you do the formula, the rate of corporation tax is actually sometimes higher than the 25% rate that applies to large companies. So it's a funny little thing. I recommend you all look at HMRC guidance a little bit closer on that formula. And like I mentioned before, All closed investment holding companies will be taxed at 25%. That's going to catch out a lot of property investment companies, a lot of any closed company, which is an investment company. So yeah, that's quite harsh corporation tax rates. Next slide, please. Natalie. Okay, so R&D tax credits. From next year, it's good news if you're a large company. If you're a large company, the rate of research development expenditure credit is going to increase from 13%, which it is now, to 20% for all expenditure after 1st April 2023. So great news if you're a large company. Bad news if you're a small company. So small companies, they get relief within 2 ways. They get that additional booster relief on their any cost that they spend. Currently, it's 130% of any costs. They can get it as an additional corporation tax deduction. That's going to reduce to 86% for next year. Also, small companies which are loss-making, they can surrender their losses for a cash repayable tax credit. That's currently at 14.5%, but it's going to be bad news for next year. It's going to be 10%. So I'm not sure why he's targeting small companies and favouring large companies. That's something that I don't know, but that's what's going to happen. Next slide, please, Natalie. Okay, and I think this is my last slide, and this is quite a major change. Jeremy Hunt just confirmed that the NIC rates are going to stay the same. They announced this before in the little mini budget that they were going to reduce the previous rates, which were increased by 1.25%. So they announced that actually we're going to keep that 12%, 2%. You should have seen this in your pay packets this month, actually, for all employees. So they're going to keep these rates the same. I think they said something about freezing these to 12% and 2% as well. That's quite funny, actually, because if you freeze the upper rate limit at 12%, it means less people are going to be caught within the higher threshold. And if they freeze that for 5 years, less people are going to pay tax at that 12% instead of going to pay tax at 2% above it. So that's something I think they'll look at again because they haven't quite thought about that clearly. But this is it, 12% for in between £242 to £967 a week, and then 2% for earnings above. They're going to freeze it, they said. I think that's my last slide, Natalie. Oh, thank you. I'm going to pass over to Chris Rowe. He's going to speak about indirect tax updates.
Thanks, Steve. I had one online, I have one in the room. So Chris Rowe, so I'm the new VAT partner. So if anyone's got any VAT queries, with me and my team in Birmingham, which we'll deal with them. So I joined BDO last month, so I'm in mid-month 2. Joined 1st of November from EY. And as a bit of a brief history on me, so I trained at PwC. I then had a stint in industry, as Malcolm mentioned. So I worked for JCB, the diggers, up near Alton Towers. Anyone's been up that way, up my way? And then I've been at EY, or was at EY rather, for the last 8.5 years, ahead of joining BDO. That's a quick intro on me. So indirect taxes, so VAT is my main specialism. There wasn't much out of the autumn statement around VAT, so I've made it a bit broader and covered some more indirect updates as well. So first update I was going to cover was online sales tax. I don't know if anybody saw what has been tracking this, but there was a consultation on online sales tax, and this is all about trying to level the playing field between the online players and the traditional players. So traditional players being businesses that have got bricks and mortar, the high street essentially. And HMRC were essentially looking at a way in which they could tax online sellers to therefore use that money to reduce business rates. It's quite complicated, as you can imagine, because it's kind of coming up with a whole new tax. It's, do you tax it per transaction, percentage of turnover? How would you do it? So HMRC put a consultation out, asked for responses, which they got, and now they've decided not to implement it, actually. So that's what was confirmed in the autumn statement. Probably, I assume, because it's quite a complicated thing to introduce. There was quite a lot of backlash, as you can imagine, from online sellers as well. They'll pay more taxes. So for now, that's not going ahead. In terms of VAT, the current registration threshold of 85 and deregistration threshold of 83 can be maintained. for an additional 2 years. And given inflation is currently at 10%, they're going to capture a lot more businesses who will fall into the VAT regime. Stamp duty land tax. So as expected, that the changes in September have been confirmed as being temporary. They will end at the end of March 2025. Some good news around customs. I say some because it's quite limited, quite specific. But to ease pressure on cost of goods for some UK producers, there's been some tariff reductions. But as I say, very specific. So if you're importing aluminium bicycle frames or certain foodstuffs, then you might benefit, but it really depends on whether you fall into those reductions or not, essentially. I think it's got a slide of 100 goods. So it's not massive, a bit more of a headline than actual benefit, I would say, and in broadest terms. Electric vehicles. So bad news for myself. I bought an electric vehicle last week. So in terms of the taxes, HMRC are essentially trying to tax electric vehicles more in line with normal vehicles. I think that's just taxing the trend and the shift. Still beneficial, but not as good. So for the first time, electric vehicles will have to pay VED, so vehicle excise duty. So for new vehicles from April 2025, they'll pay the lowest first year rate, which is £10 currently, and then they'll pay the standard rate, £165. And for vehicles purchased between 2017 and 2025, they'll fall into the regime rather at the standard rate. So more taxes around electric vehicles. The other thing was around benefits in kind. As you guys probably would have seen. So that's currently at 2% on electric vehicles, but it's going to be increased to 5% by 2028. So slowly increasing taxes. As I say, still easements, but increasing taxes. Go to the next slide, please, Natalie. So the final thing to leave you with on this was government announcing that they're going to invest £79 million over the next 5 years in additional resource. And they're aiming ambitiously, I think, to bring in 725 million of additional tax revenues in that period. Quite ambitious, but as I've seen more specifically in VAT, they are getting more on the front foot now. So definitely aiming to increase revenues, and with that kind of money being spent, they're going to definitely be held to account to deliver something anyway. Is that any questions? Yours, Sadiq, first part.
Yeah, I've got one for Sadiq. Yep. I think if I understood you correctly on the national insurance limits, yeah, are they saying that the threshold on which you pay national insurance is frozen?
Yes,
so
that's right. Sorry, what I was meant to say was they're freezing the thresholds and they're keeping the rates at 12% and 2%. So if you freeze the thresholds and an employee is earning more through inflation in the next 5 years, actually less employees are going to end up paying the 12% national rate, national NICs, and instead they're going to be paying 2% because their salary is going to increase, but the threshold staying the same, and that's something they'll have to have a look at.
So when I get my big BDO pay rise, I'll be quids in.
Yeah, you would. Yeah, everyone's happy.
All right, there you go.
Yeah, but I'm taking it as a pinch of salt.
All right, yeah. It'll change. Don't you worry.
There's some temporary good news then, by the sounds of it.
There you go.
First, I've got one question. Those people who bought sort of Tesla last year, because the new rules coming from April 2025. When I have friends with Tesla a year ago as a state agent, and he got claimed 100% and VAT, etc. It doesn't affect them, is it?
It will affect them in terms of vehicle excise duty. Yeah.
Excise, but that's not much. But he's got the VAT back, etc. Can he? If he's using it for business, can he get the VAT back?
Well, it's quite a high bar to get VAT rate because it's available for private use. So
Yeah, they're about private.
it's quite a.
But yeah, but then so best to buy an electric car before April 25. Then you can get a full 100%.
Well, these changes are purely around vehicle exercise duty.
Okay, right.
And then the benefit in kind is around company cars. So if you've got electric
Yeah,
vehicles.
benefit in kind,
company
but
car.
okay, yeah, benefit in kind, I'm gonna have to come in, but you know, people, yeah.
I think the key benefit on electric vehicles is if you you use that with a salary sacrifice type scheme,
Yeah,
they're
that's right.
quite attractive. And even with the changes in vehicle excise duty, I mean, you're still quitting salary sacrifice.
But also if the company, the director says a pool car,
Yeah.
then how would you know, but then of course, question might be where the car garage and all that kind of thing goes into it.
I think the benefit's still quite small.
Still
isn't it?
quite
I mean, is
small.
anybody going to try and run that argument on a?
I mean, I think
electric
that's a
car?
disincentive for, you know, in this climate where people are trying to, you know, be green. Anyway, sorry to.
No, that's right. I think like Max, I think the benefits are still generous. It's
Yeah.
just they're being reduced, I think. So that's
Any other questions from the room? Otherwise, we'll see if Natalie's got any online. Anything online, Natalie?
No, not at the moment.
Moment?
I've just put in there to let anyone online know they please do put any questions in if they want to. So we will answer them as well.
That's lovely. And we've got Q&As at the end of each session. So come prepared. They're not all just at the end this time. So, Natalie, do you want to move on to the next slide? I think this is Chris again, isn't it?
it's me again. Sorry, bro. More VAT. My favourite subject, but perhaps nobody else's. Okay, next slide, Natalie. So in terms of the agenda then, so as we've got on screen, so we're going to cover making tax digital first. Seeing quite a bit of activity from HMRC in relation to that. We cover an interesting potential future concept around split payments. Brexit. Forgive me, 2 years in or out, bit of a Brexit joke there, but as I said, we're kind of 2 years post Brexit now, but we're still seeing lots of issues and errors being made, keeping us busy. So keen to make everybody aware of that. Given the way the economy is going, a bit of a look at cash. We're going to get lots of questions from our clients now on, you know, are there any VAT cash opportunities we should be looking at, and then deals. So we're going to look at some typical VAT pitfalls again, so which is quite topical at the moment. Quite a bit of HMRC activity, and despite the economy, we're still seeing lots of deals as well. So I thought it'd be good to highlight some of those. Next slide, Natalie. In terms of making tax digital, then, so this has been around for a while now, and I assume even all your clients are, you know, have kind of made the necessary adjustments around MTD to be compliant. I say that appreciating the fact that not all of our clients have quite got there. Some are kind of on a roadmap, which is not in line with HMRC's guidance, but you know, for various reasons that they haven't been able to sort it out just yet. However, as an additional incentive to sort it out, HMRC have released their penalties specific to making tax digital, which we'll cover on the next slide. And they're all categorised around the 3 requirements of MTD. So second bullet, so filing returns via API software, maintaining digital records, and maintaining digital links. And it's that third one which we see clients struggle with, the digital links aspect, particularly where they've got different systems or they've got businesses which are, you know, are separate essentially. So you might have different outlets, different shops, different sites, etc. So how that information gets pulled together, and also where adjustments are made as well. So you might have a good system, but then adjustments outside of that system, whether they need to be done in an MTD compliant manner or not. But some clients fall down. For groups as well, penalties are on a VAT registration basis. So if the whole group is not MTD compliant, so the penalties then multiply up. And the other point to this is HMRC are expecting businesses to use their making tax digital compliant VAT return process to actually identify other errors. So that checking functions piece. This is where we're seeing. So, for example, if a business has made an error, typically now we're seeing HMRC say, well, can you share with us your MTD compliant workbook? or explain to us what software you're using. So if the business hasn't got that in place, HMRC are typically being a lot harsher around penalties. Because in terms of that reasonable care argument, it's, well, you haven't got an entity compliant process, so clearly you're not taking reasonable care when it comes to VAT. And also we're seeing it come up where clients have got a repayment return, which is then flagged by HMRC for a pre-credibility check. It's not just, can you send us your top 10 purchase invoices, which is what it used to be. Send them, it's released, job done. It's, can we have that? But can we also see your MCD compliant workbooks? It keeps coming up, and audits, etc. As everyone will appreciate as well, it's the penalties, we'll come on to MCD penalties, which are massive. Don't add up, but they're not huge. But if you're making a sizable error and you're not MCD compliant, then you're going to be looking at a much higher penalty, as we said, potentially up to 100%. We go to the next slide, Natalie. Just to cover off on the MCD specific penalties. So if you don't file using MCD compliant software, it's up to £400 a return. If you don't maintain digital records, it's £15 a day, going up to £5,475 per annum. And if you don't maintain digital links, same penalties as with records. But if you're kind of not meeting any of those requirements, then it's fairly sizable over every year. And for this reason, we are seeing this come up a lot more around deals as well. So it's not, so one of the things we check around deals now, as part of your due diligence, is have you got an MCD compliant process? Delving into that, buyers want to know what they're inheriting. That's MTD. The only other thing to mention around penalties while we're on that subject is there's a new default surcharge regime. So for late filings and late payments of VAT, it's moving to a points-based system. There's an easy in coming out on that this month. It should be this week actually. That's coming in from the 1st of January 2023. It's actually good news on the whole, because late payments HMRC are being a bit more lenient on, which is good. Clients in the past which have been subject to very high penalties for paying VAT a day late, for example. So, and some good news there, and things really easy when it comes out. So that's that. Next slide, Natalie. So split payments then. So this is not one for now. It's one that's on HMRC's radar. It's something they're looking at. Essentially, what it is so it's an anti-evasion measure, and instead of you paying VAT to a vendor, then taking that payment of VAT, putting that liability on their VAT return, paying their VAT return liability, and the money is then getting to HMRC. It's at the point of sale. And HMRC are looking at this in terms of online sellers, particularly online sellers which are overseas businesses. So what they would ideally like to happen is, we all go online, we make a payment, and instead of that, the full payment going to the vendor, VAT is carved out of that and goes straight to HMRC. It's something which is used in a number of countries, South America being a particular example, where it's more prevalent. And what HMRC have published is essentially it's a procurement procedure, which is what we've seen triggered. So they're looking for an innovation partner or partners to build a proof of concept. At that point, they will assess if and how it should work and when it could be implemented. So it's quite interesting, very different to what we have today. But in terms of where this could lead, I suppose the most natural area it could lead to is just all online sales. Outside of that, difficult to see where else it could be used really. Who knows where HMRC might go with that. What I would say though is the VAT gap in the UK is in the tens of billions. Going back to the point around HMRC investing all this money in more staff. And this is clearly another investment they're making in technology. They have already made a lot of investment in technology around making tax digital as well, both to receive returns, but then also in analysing them through data analytics. They are getting a lot smarter. And I think the problem that they've had today is they haven't had the people to actually go out and properly audit businesses. They've got the people, so if they're trying to recruit, and they can utilise their technology, we might actually see HMRC a bit more on the front foot. Next slide, Natalie. The Brexit. So yeah, I don't for an apology for me for mentioning Brexit. I know we're all kind of sick of Brexit, but as I say, we are still seeing lots of queries and lots of errors actually, both on the UK side and also on the European side as well. They're still keeping us busy, particularly in customs. Some kind of common examples I put on the slide there of what we've been seeing. So the first one is around import VAT recovery. So most people will probably know that you can now use postponed VAT accounting for import VAT recovery instead of paying the VAT at the border or paying by a duty deferment mechanism. You can now recover your import VAT and pay your import VAT on the VAT return, so nil VAT entry essentially. You don't have to use PVA, and it needs to be put on your import declaration as well. So you can still use PVA and you can use C79. As with all system changes, there's been quite a lot of difficulty with HMRC and with the PVA statements coming out, which has not helped. So what we've seen is where businesses haven't been reconciling between their own records, C79 and PVA, they're making some errors. Obviously, with both upwards and downwards. But for one client, as an example, thought that they weren't using C79 anymore and hadn't realised they were still receiving C79 statements, and actually had 200 grand of VAT, import VAT, over a year, which they hadn't recovered. But luckily, they realised this through an end of year reconciliation. But that's one example where it's leading to errors essentially. So it highlights the importance of reconciliations. HMRC challenging on import VAT recovery. So this is quite a big area of HMRC where they've changed the rules. So essentially now, it used to be that the beneficial owner, sorry, start again. If you had a beneficial interest in the goods, you could recover VAT. And that was quite easy to prove. So you might not be the owner, but you might be the future owner, if you like, of the goods, depending on how the supply chain worked. If you could prove you had a beneficial interest in the goods, you could recover import VAT. They've changed that now to say only the owner of the goods can recover the VAT, which is quite a big change. But it kind of mirrors what they do in a lot of other countries around the world, particularly in Europe. Where we're seeing clients get caught on this is things like if you've got so like warranty repairs or paid for repairs, so you're importing customer-owned goods you don't own. You can't now recover the import VAT on that if you don't own the goods. The definition of owner for this purpose is that you can dispose of the goods as owner. So you might not have paid for the goods at the point that you've imported them, but if you're able to dispose of them like you are the owner, you can recover the import VAT. We're seeing clients hit with big bills around this. And what HMRC will say is, well, you should know that A, you should know about these rules. B, you should therefore have planned around these rules and used a custom simplification. So that's an interesting area. We've seen quite a lot of incorrect custom treatment. I'll come on to say more on the next slide. But just around incorrect quality codes, preference being claimed, or when you can't prove the origin of the goods. So I guess it's all new. So if you were only importing from the EU previously, this is all new. So we're actually doing imports and exports. So seeing lots of errors there. Confusion around Incoterms. And this can lead to then you accidentally, essentially, being the importer, needing to be the importer record into a country, which can then lead to VAT and other tax requirements. And misuse of VAT, even simplifications is the final one to cover. So things like call-off stock arrangements, triangulations, anyone that's got clients to deal internationally and within the EU, there were some simplifications around that call-off regulation where you didn't have to register VAT. You could use your UK VAT registration to avoid having to register in another EU country. But now, following Brexit, you can't use your UK VAT number. You need an EU VAT number to do that. So we're seeing errors with that, and also with the EU suppliers still thinking they can use these reliefs for UK customers when they can't as well. But lots of the unravelling we're having to help clients with around international supply chains. So if you've got any clients with international supply chains, it'd be worth checking in with them as to how that's going. Next slide, Natalie. So yeah, cash flow and cash saving opportunities. So yeah, as I said at the start, with the economy softening, and we saw this with COVID as well, the natural thing for clients to do is say, actually, you know, am I claiming all the tax reliefs I can? And is there anything around VAT and customs? So if I start with customs, some example, we see lots of businesses not claiming preference, preferential treatment under free trade agreements, just because you rely on the customs broker actually processing your declarations in the right way and using these reliefs where they can. They're quite stretched, which has been widely known in the media. So if goods have just been cleared quickly, they might not be doing the most diligent job, which could cost you money. Commodity codes is another one. So is the correct commodity code being used? That can have a differential, can lead to a differential in the actual duty payable. Valuation, which is a complicated area for customs, but are you using the correct valuation? Could it be lower or should it be higher? Bespoke VAT accounting, like I mentioned, so taking advantage of that cash flow opportunity. And on the VAT side, a lot of it's good housekeeping, to be honest. So are you claiming bad debt relief? In terms of business entertainment expenditure, are you properly analysing that? Is any of that actually recoverable? So is it staff entertainment, for example? Expenses, do you recover VAT on expenses, or is that left in the too difficult bucket, so leaving VAT on the table? Or incurring overseas VAT, is there a way to get that VAT back? Depending on what you've incurred it on, there are ways. And then looking at things like VAT stagger you want, is there based on your income flows, is there a better VAT stagger that you could be on? Are you on payments on account? Do they not reflect what your turnover is now? Can we reduce those? Can we use VAT grouping? Should we de-group certain entities that are in a repayment position? So there's all sorts of things which can be looked at to make sure that you're in the most efficient setup. I've got about use of data analytics. I've definitely found that that's key when you're looking at these things. If you can imagine you've got all this data, you go, well, I don't know, who knows? I've got time to look through all my transactions to see if I've got any cash opportunities. Data analytics is a quick way of identifying those potential opportunities, which then need validating. And we've got VAT data analytics tools and customs tools which we use to do that. The potential opportunities. What I will say is this is a bit of a double-edged sword, though, because you might, whilst you're doing this, find errors as well. So it's almost a bit of I'll say it's a VAT review which is kind of a health check with the view to find opportunities, but also flushing out any errors which might be in there as well. So it's double-edged, but equally double benefit depending on how you look at it. And then next slide, Natalie. So yeah, restructuring and deals. So as I mentioned, despite the economy, we're still seeing lots of deals. This is another area which HMRC don't particularly like from a VAT perspective. So deal fees is the main area of challenge we see from HMRC. It is active challenge. So particularly where businesses make it so good practice on the one hand is to not recover. So if you've got a complicated deal, not to recover VAT. Put it to one side, and then at the end of the transaction, look at that deal and say, right, okay, the deal actually panned out like this. Okay, we can get this much VAT back, and then putting in the claim to HMRC. That's good practice from a VAT perspective to make sure you haven't made an error. But equally, it might lead to then a claim being made, which is what we've seen. What we should have the typical mechanism, depending on the amounts involved, which then might lead to HMRC questioning. And we're seeing HMRC being quite challenging around that, asking lots of questions, wanting to know all about that deal, what the costs were, at what point they were incurred, because what they're looking at as well. So if you've got a UK share sale, for example, which should be exempt from VAT, what VAT are you capturing as part of that? So by that I mean, how much VAT are you restricting? Is that the right amount of VAT? Did you do any restructuring immediately before it? Did you recover that VAT, not recover that VAT? They want to ask all these questions. Other areas that look at challenging around this is around holding companies, which is favourite topic of HMRC. But the crux of this is, so if you've got costs sitting in a holding company, it's what does that holding company do? But if it's just a passive holding company, it's not managing its subsidiaries, doesn't have any taxable activity, then likely it has no right to recover VAT. Whereas if you've got an active holding company, HMRC would expect to see services agreements in place with subsidiaries, costs being charged down. They expect to see invoices actually raised and properly paid. I say that because HMRC don't like netting off the intercompany account. They like to actually see it being paid. So it's kind of justifying that you have got taxable activity and therefore you can recover VAT. So restructuring generally, what you want to avoid is doing things like a UK share sale if you're trying to restructure a business, because as I say, you can have an exempt transaction. So what you could do instead is use things like VAT grouping, effectively, because transactions within the VAT group are disregarded. Or you can look at TODC, essentially, so you're not creating exempt income. In terms of due diligence, so how can your clients prepare? I think it's if particularly if you're thinking about, or your client's thinking about a future exit, it's making sure your VAT affairs are in order, essentially. So a VAT review would definitely be recommended. It's if you know you've got a particularly complicated business from that perspective, it might be partially exempt, might be financial business, applying some exemptions, then it'd be worth checking, challenging yourself on whether that treatment is correct. That was everything I was going to cover, I think. I think that's the end of my slides, actually. Yes. So, any questions?
Just a reminder for those online, if you've got questions, do pop them in the chat and Natalie will pick them up.
Any questions from the room?
Last one, Chris. Your split payment slide frightened the living daylights out of me.
We're a long way off.
It's a long way off. Yeah. I mean, the thought that crossed my mind is clearly at the moment, you sort of do your VAT return. I think you still do VAT returns, so you're still under MTD.
Yeah.
Where you net off your input tax and your output tax and you pay the net. Now, clearly, if your output tax is all dashing off straight to HM Revenue and Customs, that's going to give you a cash flow disadvantage. And I just wondered whether there's anything on the input tax side which would speed that up as well.
Well, the only thing on that would be to switch to monthly returns, for example, because then you're going to get the input back on a monthly basis as opposed to quarterly.
Nothing in the sort of proposals.
No, nothing in the proposals. No.
What a surprise.
Surprise, indeed. I mean, as a kind of jurisdiction, we're very unsophisticated in the UK. So the HMRC had these grand plans to make us very technologically advanced. But if you look at India as an example, so in India, if you want to claim input VAT, you can't claim that input VAT unless the Indian revenue the output tax has been paid. So they track that through to the supplier, and they go, yeah, tick. In this is all in their fancy digital system. Tick that output that's been paid. So yes, okay, you can have your input back now. So they're kind of netting off just like that. We're so far behind. I think that's the advantage of implementing systems later. So yeah, ours came in 1973, so it's pretty outdated. Even with making tax digital. Any questions online?
No, it's all good here. Thank you.
Over to you.
Thanks, everyone.
Okay, hello everyone, and hello to everybody online. My name is Piyush Patel, and I work within the tax dispute resolution team within BDO. I started off way back in HMRC and worked for a number of practices, and I've been at BDO for about 6 years almost now. Natalie, can we go to the next slide, please? This first slide is just a brief introduction of what TDR do and how it can help. We liaise with HMRC on a daily basis, dealing with tax investigations, tax inquiries, voluntary disclosures, anything where HMRC have identified a tax irregularity. The purpose of the talk today, of what I'm about to discuss, is to discuss a particular area of focus that HMRC are looking at, and also to discuss the tax strategy that HMRC appear to have adopted in order to tackle tax non-compliance. And to give a bit of background, in the spending review of 2021, HMRC received an additional £290 million in order to tackle tax non-compliance. In the recent autumn statement, HMRC received an additional, or will receive an additional £79 million. And that's to tackle tax fraud and tax non-compliance amongst the wealthy taxpayer group. And just some more stats that were published recently. In the 6 months to 30th September 2022, compared to the same period in 2021, the number of inquiries HMRC opened and closed has gone down. The compliance yield that HMRC have brought in has gone down. Surprisingly enough, the number of there's a fraud hotline, and the number of callers they're receiving to accuse other taxpayers of fraud has gone up. So what is HMRC doing to tackle tax non-compliance? So the number of inquiries has gone down, the yield has gone down. What are they doing in order to bridge the tax gap? And that's where we talk about the tax strategy that they appear to have adopted. And before we talk about that, there's two fundamental components that HMRC need before they can implement the tax strategy. First component is information and data. Various government departments collect data, so UK data is available. HMRC has special data powers in order to obtain data, not just from intergovernment departments, but from third-party organisations and companies as well. The implementation of the Common Reporting Standard means HMRC has information from jurisdictions and tax authorities around the world. So HMRC has the data, has the information. That's one component. The second component would be it needs a sophisticated computer system in order to collect data, interrogate data, and identify any tax irregularity amongst the taxpayer population. And it's got that in, it's called Connect, which has been around for a few years now. And I think we're seeing the full effects of Connect over the last 2 or 3 years. So HMRC has these two components. So what is the strategy that HMRC is adopting in order to tackle tax non-compliance? Can we go to the next slide, please, Natalie? We've probably all heard of it already. The strategy they appear to be using is the use of nudge letters. And we'll talk a bit more about nudge letters and what they're currently doing later. But a nudge letter is exactly what it says. It's a letter that goes out to a taxpayer that nudges the taxpayer to review their tax affairs, check their tax affairs to see if they've done anything wrong. Have they made any errors on their tax returns? Have they not paid the right amount of tax? And in practice, what we see a number of taxpayers, number of clients come to us saying we've received a nudge letter, and their first thought is they are quite distressed by receiving such a letter, quite scared that HMRC have their information, found out their information. Majority of these taxpayers didn't realise they had an obligation to disclose. It's mainly to do with offshore income, but they didn't realise they had an obligation to disclose. They were unaware of their obligation, and it's quite distressing. But HMRC's purpose of these nudge letters is, they say, is to educate taxpayers, to make taxpayers aware of their obligations. And it's a really cost-effective way for HMRC to tackle or to target a mass audience. Another name for a nudge letter is a one-to-many letter. It's one letter that goes out to many taxpayers that fit a certain criteria. And HMRC's Connect system does this, and it's quite a cost-effective way of dealing with it because HMRC's computer system receives information. HMRC's computer system can check a taxpayer's tax return to see has information been disclosed on tax return, and if not, HMRC's computer system issues a very standard generic nudge letter. So at this point, the cost is very minimal to HMRC to issue a nudge letter, and the fact that it can issue this to thousands of people that fit particular criteria is a very cost-effective tool for HMRC to tackle tax non-compliance. There appear to be 3 types of nudge letters. One is based on information that HMRC has received, especially from offshore jurisdictions. So HMRC knows an individual has offshore income and gains and prompts the individual to come forward and make a disclosure. Some are speculative, and HMRC's language in that letter would be softened and say, you fit a particular criteria. Do you want to check your tax affairs? If so, you may need to come forward. And others are more educational. For example, individuals, HMRC knows individuals that have invested in crypto assets, and HMRC understands that the taxation of crypto assets is complex. So again, very soft language. We know you've invested in crypto assets. We know the tax on crypto assets is complex. You may need to make a tax return in advance. It tells HMRC, it tells the taxpayer in advance a tax return by the 31st of January next year. And if you need any help, here's all these links where you can go to. So some of the letters are educational, some are speculative, and some is based on information that HMRC has actually received. Where HMRC has received information, it requires the taxpayer to complete a certificate of tax position. Now that's mentioned there on the slide because it's quite an important statement, and the CIOT have issued specific guidance regarding the certificate of tax position, and all advisors and taxpayers should be aware of that guidance because it effectively says there is no legal obligation to complete such a certificate, and incorrectly submitting a certificate of tax position is can be seen as a subject to prosecution. So it's a quite an important statement issued by CIOT, and care should be taken before any taxpayer or agent completes a certificate of tax position attached to nudge letters. The number of clients we get through who have got to the stage where they've already completed and submitted the certificate of tax position, and they now need help with the disclosure, which is fine, but they should have taken advice before they actually sign the certificate. Implications of being nudged, or in HMRC terminology, prompted. HMRC again see this as them being helpful, but they penalise taxpayers if they've been nudged. If they've received a nudge letter and they then come forward and correct their tax position, the levels of penalties are higher than had they have come forward voluntarily on their own. So the minimum penalty for coming forward voluntarily is 0%. The minimum penalty for being prompted, depending on the category of behaviour, would be 10%. When it comes to offshore matters, the minimum penalty is 100%, which increases to 150% of the unpaid tax if HMRC have sent you a nudge letter. So HMRC has spent a lot of time designing these nudge letters. They've done a few trials, and it seems to be that this is the way that they're going to target a large number of the UK taxpayer population. And we're going to see shortly the number of nudge letters that have been issued by HMRC just this year. And it looks like this is going to be a pattern that will continue going forwards. Natalie, can we go to the next screen, please? So that's a list of all the nudge letters that HMRC have issued and sent out this year. There's one missing on there, which we'll talk about under offshore. But those are all the nudge letters that HMRC have issued. And HMRC obviously see that this is a cost-effective way for them to reach a number of taxpayers that fit a wide criteria, a wide area covered in that list there. And they don't really need to do any work until taxpayer either doesn't apply by the deadline or a taxpayer makes a disclosure or submits an amended return. We'll go through a few of these. Right at the top, persons of significant control are quite prominent. HMRC's got data from Companies House that shows a taxpayer being a person of significant control. HMRC has got data that shows the percentage of shares a particular taxpayer holds in a unquoted company. HMRC also has tax return that this individual would have submitted. So if a person of significant control, his shareholding has decreased, HMRC would expect to see a capital gains liability appear on his tax return. If the system identifies a person of significant control with a reduction in his shareholding, but no corresponding CGT on his tax return, HMRC computer automatically will generate a nudge letter to the individual. They were issued in respect of the 2021 tax return. So HMRC identified an individual who was a person of significant control. Maybe they weren't the following year. They expected to see a CGT liability, but then wasn't. So a nudge letter went out to those individuals. They had a 30 or 60-day deadline by which to amend their return if necessary. Persons of significant control earning below £100,000. I've seen one of these very recently, and this is more speculative. This is what HMRC is saying as a person of significant control. It's not just your salary or your dividends that you should be declaring on a tax return. There's a wide range of other income streams that could apply. And the letter, I think I've got one, I can refer to it later if anyone wants me to, list other income streams that are applicable for a person of significant control, and says these may apply to you. And if you do think they apply to you, you might want to amend your last return, and you might want to make sure your next tax return is done correctly. If there's nothing wrong, there's nothing you need to do. So it's a very softer letter, but again, HMRC reaching out based on information that it's already received. Landlords is an interesting one. Landlords who would deposit rental income into a tenancy deposit scheme. HMRC has access to the tenancy deposit scheme data. So if a landlord puts in 1 month's rent, let's just say that's £10,000, HMRC would then check the tax return and expect to see 10,000 times 12 as gross income. And if it doesn't, a nudge letter has gone out to these landlords. I think those nudge letters were just issued last month. Of course, there could be a perfectly good explanation. There could be vacant periods. So maybe the individual didn't rent the property out for the full year, but HMRC, cost-effective way of reaching these landlords, saying we expected your rental income to be higher, but it wasn't. So do you want to check your tax return? One-to-many letters, again, same thing as a nudge letter to individuals who drive for an online platform. So we're talking about Uber drivers, Bolt drivers, Lyft drivers. HMRC has used its data access powers to obtain information from these companies, and it compares that information to the tax return of a taxpayer. If there is a mismatch, a nudge letter has gone out to these individuals. Foreign tax credit relief is another interesting one. Individuals who on their 2021 tax return claimed foreign tax credit relief in respect to foreign employment. HMRC have issued a nudge letter saying you might want to check your claim, especially if you're going to make a claim next year as well. And in particular, HMRC are referring them to the double taxation agreement, saying if that country isn't allowed to deduct or withhold tax according to the DTA, you need to make a tax relief claim from them and not from us. So HMRC is almost forewarning them in advance, but also looking at last year's tax return. Residency and RBC, an individual, a taxpayer who has claimed the remittance basis on their tax return And HMRC now knows in advance for the 2021 tax year, either the taxpayer was now resident in the UK for more than 7 out of 9 years, or more than 12 out of 14 years. And HMRC would therefore expect on the 2021 return that there is either a 30,000 remittance basis charge, a 60,000 remittance basis charge, or taxpayer elects to be taxed on the horizon basis. And if any of those three are missing, a nudge letter has gone out to these individuals, I think, during the summer of this year. Mixed member partnerships is a very hot topic. HMRC have focused on partnerships for a number of years. Just to clarify, we're talking about partnerships that involve individuals and a corporate entity. And HMRC are aiming to reach out to the whole mixed member partnership population and saying you want to check. It's very complex. It's a very complex area of tax. You might want to check you do not fall foul of the mixed membership rules. We've got a couple of ongoing inquiries within BDO at the moment. And even though they've got ongoing inquiries, they are still receiving these nudge letters because HMRC aims to get out to as many of these partnerships as possible. Offshore, as a result of CRS, HMRC issues letters we've seen in batches focusing on particular jurisdictions. We know that since about February or March this year, all the way up to about August, September, India was a particular focus, and we received a number of calls from taxpayers who have bank accounts in India or property in India, and they've received nudge letters. So HMRC focus on jurisdictions, issue batch letters in batches. And the other one that's missing, which is related to offshore, is I believe these will be issued shortly. Offshore corporates holding UK residential properties, and HMRC has this data. There was a new register set up recently, so HMRC has data of these offshore corporates. It knows the number of offshore corporates that own UK residential property, and it will be issuing, I think it's 5,500 letters. They've either been issued or they'll be issued shortly to these offshore corporates, reminding them that they either have an income tax or an ATED liability, or they've got a capital gains tax liability that they have not previously declared. So that just goes to show the strategy that HMRC are currently adopting. And in my view, it's what HMRC will be using going forwards, picking out particular areas of focus and using its computer system to identify taxpayers who may fall foul or do fall foul of these areas and issuing nudge letters directly to these taxpayers. I did have some numbers that says that in 21-22, HMRC issued over 18,000 nudge letters, offshore nudge letters, and as a result received over 25 million pounds in tax that was previously undeclared. So that just goes to show that HMRC will continue to use nudge letters in order to tackle tax non-compliance. Next slide, please, Natalie. Okay, so this is a particular hot topic for HMRC, research and development, or claiming for research and development expenditure. As Sadiq mentioned earlier, HMRC's latest annual report estimates that R&D error and fraud costs over £450 million to HMRC every single year. That's an increase by over £100 million compared to the same annual report of 2021. We know that HMRC are increasingly focusing their compliance resources on R&D claims by issuing inquiries. We know that HMRC's fraud investigation services have issued nudge letters where they believe there's been a fraudulent abuse of the R&D system. We know that HMRC have already recruited 100 additional staff, and the additional £79 million that's been earmarked in the latest autumn statement, some of that is likely to go towards focusing on continued R&D compliance and tackling up fraud within the R&D system. Earlier in the year, HMRC announced that they were going to delay any repayments so that they can carry out thorough checks before issuing a repayment following an R&D claim. At one point, I think they paused all R&D repayment claims as they believed there was a fraudulent attack of HMRC's system. I believe the position right now is there are still extensive checks going on prior to repayments, but in some cases, repayments are still being issued. Just because a repayment has been issued doesn't mean to say that HMRC have checked and there is no further issue. HMRC still has its normal inquiry windows to check a claim and look back at historic claims as well. We know that HMRC have successfully challenged R&D claims through the first tier tribunal. And R&D is a continued focus that HMRC will continue to focus on. R&D is, I think, pretty complex. We've got a specialist R&D team in BDO, and most of any R&D inquiry we receive in the TDR team, we work very closely with our R&D specialists who are very good at identifying whether a claim is valid or whether we need to surrender with HMRC. So some of the common areas, some of the common errors HMRC pick up on R&D claims. Next slide, please, Natalie. We'll just go through a few of these. So claiming under the wrong scheme. So Sadiq mentioned earlier, there's a scheme for large companies, there's a scheme for smaller companies. The relief on smaller companies is being cut back. I don't know if that's a reflect of, I don't know if that reflects where HMRC thinks the majority of fraudulent claims exist within the smaller companies, maybe smaller businesses. I'm not sure, but businesses claiming under the wrong scheme, so larger companies claiming under the small company scheme or vice versa. Claiming excessive staff costs is a common one that we see quite a lot. An individual who is doing R&D work, you need to apportion the amount of work that they do that's relating to the R&D work in order to make a claim. And sometimes we see 100% of staff costs being allocated to R&D expenditure. Number 5 is really important in terms of no or insufficient documentary evidence to support a claim. Once you've received an inquiry, in order to support a claim and to justify a claim, you need information, and HMRC expects significant amounts of information. Not understanding the rules, as I said, this is very complex, and not understanding the rules and making mathematical errors in the computation. And finally, fraudulent claims, as HMRC and the National Audit Office think there is a significant number of fraudulent claims in circulation at the moment. The only other thing to mention about R&D claims is going forward, there's likely to be maybe another change in that at the point of making the claim, you provide documentary evidence, you provide significant documentary evidence at that point in order to explain the scientific or technological advances that you are claiming for, and to give HMRC full background in respect of the business and the technology or engineering in order for the claim to be accepted. And I think that's it for me. Natalie, next slide.
Fantastic, thank you, Piyush. Any questions for Piyush or anybody? Any questions? Just stunned you all into silence, haven't we, again?
It just shows that Big Brother is watching you, basically.
Yeah, basically, I think that's right. That's right. Natalie, any questions in the chat?
No, all good here, thanks.
We frightened everybody away. I think you're right there. I think Big Brother is watching, and Big Brother's got more data than you can shake a stick at.
Yeah, I think, and more data than people actually recognise or realise. Yeah.
I think Piyush is quite busy at the moment, but he can always do more. Fantastic. So if there are no more questions, We've overrun just slightly, but a big thank you to all the speakers. Very much appreciated. Thank you for coming, all the people who are here in the room. That's really appreciated. Those in the room, please join us for some wine and mince pies. Anybody at home, I'm afraid you're going to have to make your own arrangements because we haven't got postal facilities to post the mince pies to you. We'll be back on the 16th of February with an afternoon session, so look out for the invitation for that in January. But in the meantime, have a restful festive break, and we look forward to seeing you in the new year. Thank you all very much indeed.
Thank you.